Tesla stock keeps dropping at an uncontrollable rate, and its CEO Elon Musk doesn't seem to care. In this video, we'll be discussing Tesla's future and what this could mean for the stock price. You're watching Trade Daily. Like and subscribe for more daily Tesla stock market news. Elon Musk pushed back on criticism from one of Tesla Inc.'s most vocal supporters amid growing concern about the chief executive officer's ability to manage Twitter Inc. and his other businesses. The billionaire, who has seen his fortune shrink in line with Tesla's market capitalization, posted a tweet mocking Ross Gerber, CEO of Gerber Kawasaki Wealth Management, after the longtime investor tweeted about a perceived lack of leadership at the electric vehicle maker and said it's time for a shakeup. That marked a change from the days when Tesla's stock was soaring higher, and fans like Gerber praised Musk's managerial chops, establishing the company as the early global EV market leader. Musk replied by asking Gerber for his great ideas for Tesla and its board, and telling him to go back and read your old Securities Analysis 101 textbook. Gerber had previously tweeted on Deck 16 he notified Tesla's board that he wants to run for a seat. Other investors, including Leo Cobuan, one of Tesla's largest individual shareholders, also have called for governance changes. The discord comes as Tesla's stock is down more than 60% since the start of the year, dragging its valuation below the $500 billion mark for the first time since November 2020. Musk has sold nearly $40 billion worth of Tesla stock since late last year, with much of that going to fund his purchase of Twitter, despite repeatedly saying he would stop selling down his stake. The sales, plus the depression in Tesla's share price, have been enough to knock Musk off the top spot of the Bloomberg Billionaires Index. Tesla shares fell 8.1% Tuesday to more than a two-year low of $137.80. When asked via email for his thoughts on having gotten Musk's attention, Gerber replied, "I like it." Tesla falls on growing angst over Musk's focus on Twitter. Shares of Tesla Inc. fell nearly 6% on Tuesday after a string of brokerages cut their price targets on the electric vehicle maker's stock, citing the risk from Elon Musk's Twitter distraction. Tesla shares hit a more than two-year low of $140.86. Analysts say investors are worried that Musk may need to sell shares further to fund Twitter, and sentiment around the acquisition of the social media firm could hurt the EV maker's brand. Evercore ISI, which slashed its price target on the company's shares to $200 from $300, said investors fear damage to the Tesla brand. Daiwa Capital Markets also cut its price target to $177 from $240, citing a higher risk profile from the Twitter distraction. Tesla shares, which have lost nearly 60% of their value so far this year, closed down 0.2% on Monday as Twitter users voted decisively in a poll for Musk to step down as chief executive of the social media platform. Analysts at Oppenheimer downgraded Tesla's shares on Monday. The price target cuts come ahead of Tesla's quarterly deliveries report expected in early January amid weakening demand in China. They will lower the company's delivery estimate by 5% for 2023 and forecast an 8% reduction in revenue per unit year over year. Musk has said Tesla targets 50% growth in delivery volumes annually. However, the electric vehicle maker said it will miss the target this year due to logistics issues. China's passenger vehicle sales fell for the first time in 6 months in November and are expected to stay flat next year, China Passenger Car Association said. Even with its price target cut, Evercore ISI still thinks shares have fallen too far. Tesla shares continue to slide today, that has sent the stock price plunging by 55% since late September. The list of reasons why is long and growing longer. Today, shares were down another 6.5% at the lows of the day as of 3:25 p.m. That marks the lowest level since early November 2020. Tesla shares have been overvalued for a long time based on the fundamentals, but the promise of its growth rate and potential additional contributors, like its battery and energy segment, helped prop up its stock price. Shares began retreating this fall when demand questions surfaced in its important Chinese market. Tesla has invested to expand production at its Shanghai factory, which many believe is its most profitable. Those demand questions remain today, as the status of COVID-19 infection's ultimate effects on the Chinese economy and consumers remain unanswered. The other major overhang has been CEO Elon Musk's distraction running Twitter. The Tesla brand may be affected by Musk's increasingly public and controversial comments on the social media forum. Today, one analyst chimed in, slashing its price target on the stock by 1/3. Evercore ISI dropped its estimate on Tesla shares by $100 per share to $200, reports CNBC. While it still represents a gain of more than 40% from today's level, it's a major adjustment in the outlook. The firm said it thinks the company needs to launch a mass-market, low-cost Model 2 EV for the stock to recover. The company itself has said a lower-cost offering is in the works but hasn't given a timeline. It's possible that investors will stop selling shares and the stock will turn around before that. For now, however, some investors fear how low shares could go before any reversal. Tesla's dropping share price takes valuation below ExxonMobil's. Investors have flocked to big oil this year while fleeing Elon Musk's electric car maker. Rising oil prices after Russia's invasion of Ukraine have buoyed energy producers such as ExxonMobil. Tesla's dropping share price takes valuation below ExxonMobil's on Twitter. Tesla's dropping share price takes valuation below ExxonMobil's on Facebook. Tesla's dropping share price takes valuation below ExxonMobil's on LinkedIn. Save current progress 0%. Derek Brower in New York and Richard Waters in San Francisco. In our AGO8 print this page, receive free U.S. equities updates. We'll send you my FT Daily Digest email rounding up the latest U.S. equities news every morning. Tesla has fallen below ExxonMobil in stock market value for the first time since 2020 as investors flock back to big oil and flee Elon Musk's electric car maker. Exxon shares ended trading on Tuesday with a total market capitalization of more than $439 billion, up 1% on the day and about 67% higher than at the start of the year, according to S&P Global Market Intelligence. Tesla's market value was $435 billion, down 8% on the day and more than 60% below its level in late October, when Chief Executive Elon Musk completed his $44 billion takeover of social media platform Twitter. Musk, who recently lost his position as the world's richest man, raised the prospect at the weekend of standing down as Twitter's chief executive, bringing some relief to Tesla investors worried that he was becoming distracted. But analysts continued to warn this week that his involvement in Twitter could cause further damage to Tesla's share price. Analysts said the contrasting share performances of the two companies marked a wider stock market rotation away from growth stocks such as Tesla to value-oriented companies such as commodity producers, which often draw investors during economic downturns. As investors shift back to value from growth, the firms that have been around for over 100 years, providing the security you've come to take for granted, are once again on top of the market, said Andrew Gillick, a market strategist at energy consultancy Inverus. This isn't a blip. Exxon, once the world's biggest company by market capitalization, endured a brutal 2020 as oil prices crashed in the early months of the pandemic and fossil fuel producers fell out of favor with environmental, social, and governance-focused investors. The oil supermajor recorded its first ever annual loss and was removed from the Dow Jones Industrial Average. A year later, Exxon's management was defeated in a bitter shareholder battle with Engine No. 1, an activist hedge fund. But rising crude prices following Russia's invasion of Ukraine this year have buoyed oil producers. Exxon in October announced record quarterly profits and has since unveiled a huge share buyback scheme. Worries about weakening demand for Tesla's vehicles have been gathering strength since early autumn, although Musk's actions at Twitter have hogged more of the headlines. The concern deepened in October when the U.S. electric car maker cut its prices in China, its second biggest market and the source of nearly a quarter of its revenue. Shortening waiting lists for its vehicles in the U.S. have added to the worries. Analysts to Evercore ISI warned this week that softening demand could cause Wall Street to shift its focus from growth to profitability at the company, potentially putting a further dent in a valuation that has relied heavily on the company's breakneck increases in revenue to eclipse the rest of the automotive industry. Musk's significant sales of Tesla stock to pay for his takeover of Twitter and provide extra cash after the acquisition have also weighed on the company's shares. A $3.6 billion sale last week, the second in a month, took the Tesla chief's total share sales to nearly $40 billion since late last year when he started to sell after a Twitter poll asking whether he should sell in order to pay more tax. Thanks for watching this video, and remember, this is news and entertainment, not investment advice.